What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
Michael, we are now 4 weeks into the Iran conflict, and markets are still laser focused on oil and rates. We had Jan on last week talking about oil, and that gets a lot of the headlines. I'd love to focus today on the rates part of that equation and hear your thoughts on why rates are such a predominant force in markets today and how oil is playing into that.
Yeah. If you just looked at the rate market, interest rates are down more than equities actually since the onset of this war, looking at the 10-year bond yield or some of those ETFs. Markets worried about interest rates, obviously in 2022, and then between 23 and 25, we had a lot of this back and forth and narrative volatility around where rates are going, where the Fed is going, where inflation's going. And then we got to a point towards the end of last year where it really calmed down, which is, I think, largely why the market had gone back to new highs in terms of multiples, why credit spreads came back down to near record lows. There was really a lot less anxiety around inflation and interest rates, and we were pricing at a bunch of rate cuts this year. And the narrative was we were going to get a new dovish Fed chairperson and everything's going to be great. And that was really the case up until the end of February when oil spiked. And so now we are quickly back in that narrative volatility with interest rates. It's like nothing ever changed. The 10-year is now over 4.4%. Mortgage rates have gone up, and we're starting to see the negative impact of that on the weekly purchase applications data and the refi data as well. And I know we've been very oil focused because I think ultimately oil is what's driving interest rates and driving the stock market. And I think there's been about a 90% correlation between the front month curve in oil prices and the 10-year bond yield, and probably something pretty similar with the 2-year yield as well. So it's a compounded problem. Whereas I feel like in 2022, we had such a broad inflation problem and rates were just starting to come up and the Fed was just starting to raise rates. Whereas now we've got higher oil, higher rates on the long end and the short end. The market is beginning to has priced out all the rate cuts this year and is now starting to price in, and people are starting to talk about rate hikes. I'll say here, I don't think the Fed should or will raise rates in reaction to this spike in oil. If you think about it, there's already three things that are tightening and acting as if the Fed is raising rates. One is the 10 years yield's gone up. So obviously you can extend that to mortgage rates moving higher. Number two is oil prices are up, and that acts as a brake, as we know, on the consumer, and it flows into all sorts of things in the economy. And the stock market's down. We have a negative wealth effect situation going on the last 3 weeks. So if I were the Fed and I'm looking at this and saying, okay, financial conditions are broadly weakening. We've got wider credit spreads, falling stock prices, rising commodity prices, and it's not just oil, rising mortgage rates and long-term interest rates. Why do I need to hike? It's especially given that the impetus of this recent inflation scare is a supply shock due to a geopolitical event. I really don't understand why hiking interest rates goes towards any improvement in solving this picture. And it's funny because it reminds me, fortunately, the Fed in the US has a dual mandate. It's one of the few central banks that has a dual mandate. If I remember in 2007, that was when you and I started working together. And then again in 2011, the ECB raised rates as commodity prices were ripping and the markets were starting to weaken, both those periods actually. And the ECB has a single mandate. It is inflation, period. So historically, they have raised rates, and I wouldn't be surprised if they did it again. Again, I just don't understand why that is going to help. You're just making the ultimate demand destruction that you're going to get from falling stock prices, rising long-term rates, and rising oil prices, among other things. You're just making that worse. And central banks aren't often that forward-looking. They tend to be very reactive. And I think that they should be patient to see how much demand destruction this does cause. And perhaps maybe they don't need to raise rates because the markets are doing it themselves. But so one part of me, I'm not saying that you should be fighting the market pricing in higher rates, because I understand why investors behaviorally are reacting that way. I just don't think the Fed will raise rates, and we'll see what happens.
So behaviorally, you mentioned, I think one of the things that you've been highlighting for a couple of years now, which is so interesting, is the paradigm shift we've seen in how inflation is on the front of people's radar these days, coming out of COVID. It's such an interesting nugget that you've put in there to explain why we are so focused on rates today.
You're talking about the correlation of interest rates and equities, which from the late 90s, well, let me start even further back. The beginning of the chart I have is beginning in the mid 50s. And basically from the mid 50s all the way through the late 90s, interest rates and equity prices are persistently negatively correlated. And that should be no surprise, because right in the middle of that is the big inflation shock we had throughout the 70s. And then the 80s and 90s gave us a similar correlation, but a very positive outcome, because inflation, of course, came down for 20 years. And then beginning in the late 90s, we saw a positive correlation between interest rates and equities. My interpretation of that is that investors were growth focused. They were not worried about interest rates. And I can't think of a time where the stock market went down between, call it early 2000s and 2018, because interest rates were moving higher at the same time. And so the better growth was in that backdrop, the higher stocks went, and they weren't fazed at all by rising interest rates. And that all changed in 2022 and has left quite the amount of scar tissue and PTSD and persistent fear of we're back in the 70s and interest rates are going to skyrocket. And of course, the deficit is exacerbating those fears. And this recent conflict is also exacerbating those fears, which makes me believe that this behavioral shift, which began in 2022, is not going to end anytime soon. And this has huge implications for asset allocators, where the 60-40 bond equity portfolio worked really well when the market's growth focused, because bonds acted as a diversifier. Now, bonds are often the reason stocks are falling. So there's no diversification benefit there in treasuries, which is probably why you've seen that kind of multi-year shift into precious metals and crypto and private credit and other things, and maybe not private credit, but other assets that perhaps could be more diversified from equity prices and interest rates. I remember a couple of years ago where one of the big debates was whether or not the stock market was rate sensitive, because the Fed was raising rates in 23, yet the market was going up. And I think investors misinterpreted seeing interest rates go up and the stock market go up as the market not being rate sensitive. Because under the surface, we certainly saw the rate sensitive parts of the economy and the stock market underperform. And of course, AI earnings for those companies that are very not rate sensitive, the Mag 7, et cetera, it didn't really affect them. And those were such a big part of the market. But here's an interesting stat. We did a hypothetical exercise back beginning in 2023 through last week. If you only held equities in weeks where the 10-year yield was up, you gained 70% cumulatively, which is basically 100% of the equity market return since beginning of 2023, which the S&P is up about 70% since then. If you only held equities over those 2.5 years or so in weeks where rates were up on the 10-year, you actually lost money. So we've seen a very clear data set observation that equities are extremely rate sensitive. And when it's coming from an oil shock as opposed to better growth, interest rates, negative impact on equities shows up pretty quickly, as we're seeing right now.
That's pretty incredible. And it goes to that idea of we are, whether we know it or not, as a market, laser focused on rates right now. And this shock in oil and what's going on is just amplifying those concerns. And you can throw out underlying economic moves, and that's the one variable market. That's all that matters.
When we look at history in periods where there's a lot of inflation anxiety, so again, from the late 50s, certainly by the early mid 60s into the 70s and 80s and early 90s, when you had market pullbacks due to higher interest rates, which was most of them, the market bottomed every time alongside a beginning of a decline in interest rates. irrespective of the economic data, and sometimes even alongside rising unemployment rates. In fact, many of them, most recessions, if you look at the bear markets around historical recessions, a lot of people tend to think, look, markets go down before a recession because they're forward looking and higher unemployment is bad. If you look at the data in the mid 90s and backwards, it's not that the market's forward looking and higher unemployment is bad. It's that what happens typically, or what has happened before previous spikes in unemployment, or essentially what causes them, is broad financial tightening. So it's a Fed tightening cycle and higher interest rates and higher oil prices. In fact, this recent oil spike now makes it the 9th time since 1950 where we've been in a period of rising unemployment where oil has spiked, which is crazy because a year ago we were highlighting that this is one of the positives, that we didn't have rising oil prices, even though unemployment was slowly moving higher, and that we were unlikely to see a spike in unemployment because we hadn't seen a spike in oil. Of course, now that changes the calculation a bit. I think we need to see a much longer sustained period of rising oil before that really leads into that. But again, I would not be surprised to see some demand destruction in the data in the coming months. And that's what I think is starting to change with respect to the market. You mentioned one variable market because oil is driving interest rates, and those both are driving the equity market. And when we look at the stock market's reaction to oil and interest rates, between, let's say, S&P 7,000 or 6,900 and about 6,700, you saw a pretty steep slope between interest rates and oil as a composite and the reaction to the equity market. And in the last week and a half or so, that slope has flattened. And what I mean by that, it's taken less of an increase in oil and interest rates combined to cause the same decline in equity markets. So we're beginning to see markets negatively respond, or more negatively respond, to the same percent change in oil and rates. And I think the reason that is a couple things. One, every day this lasts longer, the potential negative outcomes broaden, the tails get fatter, the outcome becomes more nonlinear. And really beginning this week, we started to see data that's now reflecting this pop in oil prices. On Friday, we saw Michigan sentiment and short and long-term inflation expectations rose. And this is one of the things we talked about a couple of weeks ago, why the market wasn't down more, because investors hadn't gotten smacked across the face with the actual data reflecting higher oil. Now that's happening. And that, to me, that makes a lot of sense, that you're going to have a more negative impact to a change in oil prices as this story grows longer and older.
Are there any positives?
I mean, yeah, there's definitely a bunch of positives still. One, the economy has a tremendous amount of stimulus, even in the face of these higher energy prices and interest rates. And I think it's one important nuance to note is that typically when the economy does begin to broaden out and rebound, you do see higher oil prices and higher interest rates. And oftentimes not too far from what we've seen so far. Of course, the speed of this and the uncertainty surrounding it is a huge negative, which makes it very different from a typical recovery where oil and interest rates move higher. But again, a 50, 60, 70% increase in oil prices in an economic rebound is not unheard of. Same thing with the 10-year yield. So again, it's not a positive, but it's just some context that usually if things are getting better, you would see these heightened inflation pressures. And then the second thing here is that the data's held up pretty well. We look at earnings estimates are at record highs for large, mid, small, equal-weighted S&P indices. And the economic data, the Bloomberg Economic Surprise Index today is sitting at a 2-year high. So will that change? I think so. And I think over the next several weeks, we're going to start to see very clear evidence of, in the soft data particularly. But I'm not really concerned at this point that we're heading into a recession. But that doesn't mean we should be buying stocks hand over fist in the face of this story continuing on. Because again, ultimately for me, I think the risk here is all about inflation fear and multiple compression, much more so than any big sustainable hit to earnings or the economy.
Thanks for your insights, Michael. Hopefully we get a resolution soon.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.